90% of startups fail, yet millions of people invest in them every year. And no, most investors don't lose money because they are unlucky. They lose because they don't know how startup investing actually works. There are 3 mistakes that almost always show up. No strategy, no portfolio logic, no risk management. In this video, we are breaking down why most startup investors fail and how you can avoid the same traps. To guide you further, we are also creating a beginner-friendly startup investing course that teaches you how real investors think and how to spot high-potential startups early instead of chasing hype. You will find the link in the description box. Now, let's break down exactly why most startup investors lose money and how you can avoid making the same mistakes. Let's understand startup reality. Out of 10 startups, 7 shut down completely. 2 barely return money. Only 1 becomes a big winner. This is not a negative assumption. This is startup math. Most investors believe this founder is smart. This idea is big. This market is booming. But being smart doesn't guarantee success. Even the most brilliant founders can fail. The real reason most startup investors lose money is not poor judgment. It is the structure of startup investing itself. Startup investing works very differently from traditional investing. It follows power law economics, where a small number of companies generate most of the returns, while the majority produce little or nothing. It is exactly how even famous investors build their fortunes. Peter Thiel is widely known as a legendary angel investor, but much of that reputation comes from one early investment, which was Facebook. In the same way, Axel's long-term success was largely driven by Facebook. While Benchmark's history is closely tied to companies like Uber and eBay, they made thousands of investments, but only a few truly defined their returns. When this structure meets real-world execution, the odds become even tougher. Also, most startups do not fail because founders lack talent. They fail because the market is smaller than expected. The product does not solve a real problem, or the company runs out of money before it can scale. Quibi shows how harsh this reality can be. The company raised around $1.75 billion, hired top talent, and launched with massive attention. On paper, everything looked right. In reality, the product never fit how people consumed content, and the company shut down in under a year. The bitter truth is that the media highlights unicorns, IPOs, and billion-dollar exits, while thousands of failed startups quietly disappear. What gets ignored is that for every Airbnb success backed by investors like Sequoia Capital, there are hundreds of unsuccessful travel startups such as Stayzilla and Tourist that raised millions in funding but still quietly disappeared. And even if a startup survives, investors can still lose money because of pricing. Valuation matters more than growth alone. A company can expand rapidly and still be a bad investment if the entry price assumes perfection. WeWork is a clear example of this. The company scaled fast, raised billions, and became globally visible, but at a private valuation of $47 billion. Even small problems became fatal. Billions in paper value disappeared, not because the business collapsed overnight, but because the valuation did. That's exactly why we created Learn How to Invest. In this course, we break down how startup investing really works, how to build a diversified portfolio, how to evaluate startups without hype, and how to avoid the exact mistakes we're discussing here. Learn real-world investing today. Link is in the description box. Now, let's continue. Human factors increase the risk of investment failure further. Startups are built by people under extreme pressure. Founder conflicts, leadership mistakes, and team breakdowns end more startups than bad technology ever does. Even Sequoia Capital has acknowledged that people risk is one of the biggest causes of startup investment failure. Investor behavior often makes things worse because many investors place large bets on just a few startups instead of spreading risk widely. In a power law system, this approach is dangerous, which is why investors like Naval Ravikant took the opposite path by making hundreds of small bets, knowing that only a few needed to work. His early investments in Uber, Twitter, Yammer, and Notion ended up defining his entire portfolio. Investors do succeed in startup investing, but not by guessing or chasing hype. Firms like Sequoia Capital, Axel, Benchmark, Anderson Horowitz, and Y Combinator, along with investors such as Peter Thiel, Naval Ravikant, Reid Hoffman, Mark Anderson, and Ron Conway succeeded by building systems, diversifying aggressively, accessing strong deal flow, and understanding how the startup investing game actually works. Startup investing is not easy money. It is a high-risk, long-duration strategy that demands deep understanding. If this video helped you, make sure to like, share, and subscribe for more such videos.